guys, Brian Stevens here with the National Real Estate Post. I have Chris Martin with Oak Tree Funding, who you've met a number of times on our show. And I wanted to have him on for a couple of reasons. One, there is a new proliferation of non-QM products out there that I think loan officers need to know about, especially with the difficult times that we have in front of us and the more difficult times that we're going to have going forward with the shrinking market. The first question is they were talking about commoditizing the non-QM market. And commoditization for a market means standardizing the products. So I think you could get standardized ratings, and so you can bundle and kind of move along. What they were suggesting at the expose that they had down in Southern California was it might be too difficult to do at this point. What are your thoughts on that?
I agree. I mean, it would be very difficult to commoditize it right now. I mean, I think everyone's trying to, right? Everyone's, by virtue of trying to systemically say, here's our matrices or here's the guidelines, and trying to get kind of square pegs in round holes as best as you can. But right now, the power of an originator has a lot to do with their ability to find different types of guidelines, the way that they underwrite loans, the way they look at loans, and then deliver the best qualified, most likely to pay client to their investors. So, when we're looking at, how we look at our guidelines, and, we look and see how other people are doing things, and we'd say, this is how we think that it's better. There's a whole lot that it's too new. The non-QM space has been around officially since 2012, 2014. I mean, you talk about conforming loans, and they call them conforming because they conform to a certain set of rules and guidelines. And these loans, by their inherent nature and just by their name specifically, is non-conforming loans. There hasn't even been a standardization, as you mentioned, in the jumbo market. The prime jumbo space has not been necessarily commoditized. There's a lot of different, especially with the revamping of the ATR rules, just as recently as this year. I mean, there's, somebody says 43%, somebody says 45%, somebody says 50%. There's a whole, and that's just in one aspect of jumbo lending. What's difference between non-QM and non-conforming, non-QM and prime jumbo? Obviously, it talks about the credit characteristics and things like that. So then you're another deviation away. And how do you look at bank statement loans? How do you look at business bank statement loans? I just had a conversation with two investors today about how do you look at short-term rental income? There's a whole conversation to be had, and the industry continues to develop and to morph and to change. And I think that there's going to be early adapters, there's going to be late adapters, there's going to be people who are super aggressive, and there's going to be people who are less aggressive. And because of that, it's going to take a lot more time for the industry to commoditize, if it ever will. I don't think the subprime industry ever commoditized, and it was doing, hundreds of billions of dollars in securitizations on a weekly basis. I mean, there's a lot of room for the industry itself to grow, and I think that we're probably years and years away from being able to actually have a standardized non-QM guideline set. I don't think it'll happen unless a government entity was to come in and regulate and say, this is what we're going to do, which I don't see that happening either, because it's a private lender space. I don't think it's going to happen anytime soon.
Yeah, and it's commoditizing or conforming the non-conforming loans really seems like a conforming loan space solution to what they see as a perceived problem. And understand this, loan officers, when you have a conforming agency type of lender out there trying to commoditize the non-conforming space, the only thing it's going to do is rein in your guidelines and make the non-conforming space more limited in terms of the loans that we can go ahead or they can go ahead and provide for you. You were just talking about, prices and going up right now, and jumbo being a big exception. I think the average sales price for a house right now is $385,000 or somewhere thereabouts. That includes Mississippi, Alabama, and North Dakota.
Wow.
Okay. So they're messing up the curve. So when you look at a lot of communities, jumbo is the norm right now.
Right.
And so non-conforming has a unique perspective on some of these jumbo loans that loan officers could be using right now to their benefit. Can you speak to that point?
Yeah. I mean, we actually recently, as we were talking about it, rolled out a program. It's called our InterestOnly Express program. And it's a great, I like to call it, transitional program from a conforming lender, conforming brokers, if you're used to doing agency government type of loans, to a nice transition to non-QM. It does two things for you. Number one, it gives you the safety and security of knowing that your customer is going to still be approved, because we accept a DU or an LP, approve eligible or accept eligible.
That's big.
We'll accept the DU or LP, accept or approve ineligible due to loan size, up to $2 million on the program. We allow it to go interest only. So if you're looking at your conforming rate sheet and you're like, man, this customer really doesn't like this, or really can't, affordability is relative. They really have to be able to afford the payment. But if they look at it and they don't like this payment at the 5% rate, bump the rate up a quarter of a point or half a point, whatever the case might be, and go interest only. It will save your customer hundreds of dollars a month, thousands of dollars a year on their mortgage payment. And let's face it, when it's time to go refi them when all of this stuff that they're doing right now causes a recession, and the Fed is forced to lower interest rates back down, you got another customer that you can refi in 12, 24 months. And then you can get them in the 3% rate that they're comfortable with that payment, or whatever the rates go to. But it's a great transitional program. We do a lot in the jumbo loan size. I mean, you say that about the 385 average home value price. Our average loan amount is something near $800,000 a loan. Yeah. So, I mean, the clientele that we're serving, and we do a lot of DSCR loans for investors, and they have a lot of multiple small properties that they do that we can lend on. But still, our average with a self-employed borrower who's, they got a little bit of a higher net worth, they are putting a little bit more money down, they want to get, they want to be in a loan. I'm doing, and I don't know if I've ever told you this, but I probably originate personally myself a loan or two a year. I've got my neighbor who I've told you about before is the guy who did construction, who I did his loan interest only, and he loves me for it because when times are good, he can put more money on it. When times are lean, he doesn't have to pay as much. He's referred me to one guy that's also in our neighborhood, who's buying a house in our neighborhood. And then that person has referred me to 4 other people. So I'm literally doing 5 loans right now personally. And I don't even have the time to do 5 loans of just bank statement loans, guys that are high net worth, 1099 guys. So they're gig economy type workers. They do a lot of different type of sales. They earn at a very high level, and they didn't think they could get a loan because they don't have their taxes done for 2021. They haven't filed their taxes yet. When they do file their taxes, they're going to write a bunch of stuff off potentially, and they're worried about if they're going to be able to qualify or not. So we're saying, hey, we'll give you 12 months of bank statements, and we can make a loan work for you. So we've qualified these guys already. We've got loans that we're working on for them already, and those types of people are the types of people that are still looking for loans. The interest rate doesn't matter as much as the flexibility of the payment. The interest only payment, the ability to get them qualified up to 90% loan to value on a bank statement income that's what's important to them. It's not necessarily, hey, what's the lowest rate that I can get? Obviously, rate's important if they can get a low rate, but they know the market's up. They know the house prices are up. They want to be into a house. They don't want the rates to go up anymore, so they're eagerly jumping on it. They know that in a few years, they'll be able to refinance and take advantage of lower interest rates. But they don't want to be renting anymore. They don't want to be in the house that they're in. They want to make the jump up. They've been earning at a certain level. They're ready to make that next transitional move. So there's a lot to be said for getting out there and just talking about different products in different circles, because you never know what somebody's looking for.
Yeah, that was the conversation I had the last couple of times I spoke with Barry Habib. His whole thought processing was rates are going to go back down. So if you can, and this is before all the rebate disappeared on loans, take as much rebate as you can humanly possible, have the highest rate you can get right now with the understanding that that's going to get refinanced down the road. And it's also something that Stephanie Ham, a great producer I interviewed a couple of days ago on our show, she talks about how she tells her clients right now who are almost offended when they speak about interest rates by today's standards, because they have a recency bias. We kind of think today we should have the same rate we had a couple of days ago, right. And that recency bias offends people. Sure. Her response is, hey, listen, you're looking for the house to live in forever. You're not looking at the loan that you're going to live with forever. So right. Understand the difference between the two. And that's why I really think these interest-only loans are so incredibly important. The last time we spoke, I was really pushing hard on them, and you're like, well, they're not for everybody.
That's true. They're not.
But with rates going up as much as they are right now, and
they're for more people.
They're for more people, right? Don't you think so?
Right.
I mean,
yeah. I don't think that if you don't feel like you can qualify, if you can't qualify for your loan, making a fully amortized payment, I don't think that loan's right for you.
Yeah.
Number one, I won't do the loan, because if you don't qualify from our guideline perspective, we won't do the loan. They have to qualify based on the fully amortized 30-year fixed payment. I don't think that anybody should be in a loan that they can't afford to actually make the full payment on, because that leads to a whole other set of issues. If you have a fixed income and your income has nowhere to go but up, and you don't have a lot of money in savings, I mean, in 10 years, potentially, right? If you kept the loan for 10 years, you could be, I want to sell outside. I don't want to sell against the loan, but if you're a fixed income borrower, I don't know that loan's right for them. Just like I also didn't think that pay option arms were good loans for anybody who wasn't, who didn't have at least $1 million in the bank. So it's the same type of situation. I think that an interest only loan is good for more people now that rates have gone up, because people want to be able to get into a house. They want to have they don't have the pressure of having a higher mortgage payment. This helps them have a lower mortgage payment. But those people generally are going to be within their, their working, and they're going to be able to either pay more down on it. They're going to get raises. They're going to get different job opportunities. They're going to sell a house. They're going to do this. They're going to make some money. They might be able to put money down on it. And our vast majority of our borrowers are still to this day self-employed. So if we're talking about a self-employed community, that has an alternative income, it's a great program for them. Now, we talked about this for the conforming for this interest only express program, and that's mostly, I think we're going to see a lot more full doc customers that have filed their tax returns or wage earners, things like that. And again, if you're in a sales job, if you're in any type of way that you get bonus income, you're a stockbroker, whatever the case may be, your W-2, then you want to have the ability to have this flexibility in your payment. I think it's a great loan option. If you're, I don't know that it's the right loan for everybody. I don't want to paint this as a, hey, we think this is a great loan for everyone across the board, because there's lots of people that it might not be for. And it's between the loan officer, the loan originator, and the borrower to have that conversation to determine which loan is right for them. And that's the fiduciary nature of the loan officer's job. And that's I'm not going to sit here and say who it's bad for, who it's not bad for. I'm just giving you a couple of instances, but I think it's great for a vast number of people, over half this country. It's with the great, what they call it, the great resignation that's happened over the course of the past couple of years. People want to know where those workers go. Well, they're self-employed, they're 1099, they're doing a bunch of different things to help drive, and they're still making their rent payments, and they're still making their bill payments. They're still paying their credit cards on time. We haven't seen any large defaults. So that means that those people are out there. They're just not traditionally employed now. Right. So these are going to be your clients this year and next year, because they're going to be looking to buy a house. They're going to be looking to refinance. They'll be looking to do other things. And they haven't been in the position before to be self-employed. So they had to get the years under their belt. So there's a tremendous amount of opportunity that's going to be coming up in non-QM, just because of what's happening in the economy. I like to complain. My wife will say I complain about the Fed too much, but I wish that they would just stick with the narrative and go with that, not make any changes to their narrative. But what's happened generally in the economy is given people an opportunity to be self-employed, to work for themselves, to be 1099, to go after an income and a quality of life that they didn't have before. And those are going to be your customers. Those are going to be your customers for the next.
Yeah. And I'll tell you, you said a couple of things. First of all, when it comes to the interest only loan, like if I'm getting a loan and I have a loan officer, I want that loan officer to present all the options on the table to me, and then let me make what decision is in my best interest based with what's in, the guidelines. And I think being a true professional loan officer means that you have all the arrows in your quiver, you have all the tools in your toolbox. And being a true professional loan officer by today's standards is way different than it was just a couple of years ago when everyone was doing meat potato agency loans. The second thing that you brought up is you said you had one deal that turned into 5 deals. And that's something I want to impress upon loan officers right now, because we're looking at a $30 billion industry that a lot of speculating is going to be $70 to $100 billion in a very short order, meaning the non-QM space is growing exponentially when the rest of the market is shrinking. But the most important thing is you're talking about 1099 employees. So one economist was saying that now think about this, guys, 1 out of every 3 workers in this country by the end of the decade is going to be 1099. I had a conversation with this about Dave Stevens about agency underwriting guidelines needing to change because they don't take into consideration what the new profile of the 21st century worker looks like. Yet they still haven't done it. If you want to service 1 out of 3 or a third of the industry going forward, the fastest growing segment of your potential market, the only way to get these folks loans, these 1099 workers, is going to be with a non-QM company, a non-QM first company who still has the wiggle room with their guidelines and underwriting for manual underwriting to make these things work. Can you speak to that point for a couple of seconds and what loans are available, Chris?
Yeah, no, our 1099 only program is, like you said, it's fantastic for the gig worker. They have, they get a 1099 based on what their income is. We do a profile report, just like we do for a business bank statement loan. There's a little bit of a haircut on the income, and then the rest of their income's ready to be approved. In fact, two of the people that I told you the one turned into five.
Yeah,
we're actually doing on 1099 program, not on bank statements, because they had their 1099s readily available, and it was just easier for us to make the underwriting decision based on that. It's that simple. We take your 1099s, we average them out over the course of the last 12 months, and that's your income.
Really?
Yeah.
There's nothing to that. That's fantastic.
No, and it's, by the way, it's considered alt doc in our guidelines. So it has the same LTV up to 90 LTV alt doc and the same exact price adjustment on our rate sheet. Zero.
I'll tell you what, guys, loan officers, again, to be a professional loan officer, you need to understand these products. Jumbo products, interest only options, bank statement loans, your 1099 clients or potential clients, the direction of the market. We always say sometimes you got to ride the horse in the direction it wants to go. The non-QM space right now is the direction the horse that you're riding wants to go. So you need to really understand the products that are in front of you. And one of the cool things too, just in closing here, that I've always admired and loved about Oaktree and what you guys are doing is your account reps are really well versed with the product, so they can explain the products to loan officers and are ready, willing, and able to do this. But they're also willing to help them with the ability to sell this to both consumers and to real estate agents, right?
Absolutely. We've done a lot of training with our folks. And, listen, as rates move up, who is the woman that you're talking about that said their customers were getting offended? I apologize. I didn't.
Stephanie Ham.
Stephanie Ham. She hit the nail right on the buzzer, because we had a lot of time, in the course of the past couple of months that, and it was happening. It wasn't just borrowers. It was loan officers. I've been in the business 15 years. I've never got a rate that high. Well, welcome to the new norm. I mean, right. Rates are just higher now. And if you can take, and once the customers and the brokers have to accept it, that this is where the new normal is.
Yep.
And will help your customers be able to accept that's going to be a big part of the way. But Brian, you keep talking about how much you love our interest only programs.
I do.
When are you going to sign up for one? I haven't gotten your application in yet. So I'm waiting for you to call me to say, hey, I need to get this interest only loan. And then I could show your audience. I mean, but I've got this low rate. Yeah, but what's that low rate doing for you right now, Brian? I mean, honestly, you're trapped. You don't have access to your home's equity. I mean, and our people are trained to assist you with different types of sales strategies in order to be able to capture more business. Because listen, they can take the second HELOC, and guys, what are HELOCs tied to? Prime.
Yeah.
When they raise prime rate, do mortgage rates go up? Not always.
No.
It's not tied to mortgage rates. But when they raise prime rates, do home equity lines of credit rates go up?
Yeah.
The same day, the next day they go up. So, I mean, there's other ways that they can tap equity, but not so good. None, in my opinion, so good as doing one loan, getting their first mortgage, getting everything wrapped in, and that's how you can help your clients save money. You can shorten their terms. You can help them out by consolidating their debts. So your refinance customer that you did 3 months ago, or 3 months, that's the wrong number, 3 years ago, 2 years ago, that says, hey, I got this great rate, but I've racked up all this debt. What should I do? Well, do you want to give them a 10% second mortgage, or do you want to give them a 6%, 7% fixed rate mortgage, shorten their term, get their loan paid off, get them debt free in the next 10 to 15 years. And then they're going to be thanking you because they have a house that's free and clear that then they can do a reverse mortgage on with you, when they're ready to retire, or whatever the case might be. It's a customer for life thought process, not just what's the lowest rate, what's the lowest payment. It's how can I make this loan work for me the best?
Right. Hey, listen, Chris, thank you so much for this today. And loan officers, do your business a favor and reach out to these folks. They'll do a great job and they'll take care of you. If you want to have a one-on-one conversation with them, and just understand these products a little bit better. And there's a handful of products here, guys. And the underwriting guidelines are not the same from company to company. You need to understand a manual underwrite. You need to understand that there can be exceptions to the rules. So company A is not necessarily working like company B. Reach out to them. They'll help you with your business. You can have that one-on-one. Chris,
I was going to say one more thing.
Sure.
Especially because a lot of your viewers, we've done business with in the past.
Yeah.
And some have had, obviously we hope that everybody had a great experience. And, one of the things that we've always been talking about as a company is our technology platform. And I want to get it out there that we've made some huge improvements to our technology. We used to have an entire team dedicated to looking at conditions and making sure that they were the right conditions that met what the underwriter had. We've completely eliminated that entire part of our process. Our system right now, you can as soon as you send your loan in and it's underwritten and approved, you can actually drop your conditions into the individual tabs so that the underwriter gets them. You send it to underwriting, the underwriter gets them, they're reviewed the next day. Our turn times are absolutely fantastic. Our pull through has gone up 40% since we integrated this new technology piece, and we're closing loans faster than ever. It's quite an amazing thing that we've been able to do, and it's really re-energized a lot of our business. Our operations team is humming and running more efficiently than ever before. And if you haven't had a chance, check out our technology. That's one thing that I know that a lot of our non-QM partners are lacking in. We've spent a lot of time and dedicated to it. You can run your deal, and if it's a non-QM loan, obviously I just talked about Interest Only Express. That's a DU product or LP product, but you can run your self-employed bank statement borrower on our AUS tool. You can get your income qualified through our income desk, and then we'll get your appraisal instantaneously reviewed the moment that it comes in. We have this thing down to a science. We know how to close loans. We know how to get loans done with exceptions. We know how to get loans done quickly, smoothly, and efficiently. And we'd love the opportunity to earn your business.
Chris, thank you so much for your time. Everybody reach out to these guys.
Thank you.
Thank you.